Okay, everyone, thank you so much for joining. I am showing you my disclosures first off to just remind you that this presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concept strategies and does not include the recommendation or endorsement of any particular security, chart pattern or investment strategy by Forex.com. This presentation has been prepared without regard to the specific investment objectives, financial situation and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange and other leveraged products involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts, they're not subject to regulation under the US Commodities Exchange Act, and contracts of difference, or CFDs, or otherwise known as CFDs, they're not available for US residents due to regulatory reasons. Okay, everyone, let's just get into some slightly more interesting stuff. Here we go. We will go through this chart in one moment. So I'm starting off with euro dollar. We've had a really interesting week in FX, certainly interesting last few days. Those of you who follow the markets will know we got a very important labour market report from the US on Friday. It showed the labour market was doing very, very well. And one would have thought, and it's really opened the discussion about tapering again from the Federal Reserve, potentially as early as December or January. We think December's a bit too early, but put it this way, it's been brought forward anyway from March. So usually when interest rate expectations are brought forward, what we tend to see is the currency rally. So one would have thought, yes, dollar will rally, looking good. However, that hasn't actually been the case at all from what we've seen. The dollar has rallied, but on a very limited basis, and it certainly hasn't rallied against the euro. Now, I'm showing you a very long-term chart. Some of you I know will be very short-term traders, but I still believe that this chart is significant. And the reason why is because it just shows just how important this 138 level is for euro dollar. So this is euro dollar. It's on a weekly chart. It goes all the way back to 2008. And if I just bear with me a minute. Let me just get rid of that and bring this chart down a tiny bit. I was talking to my colleague here, and he actually pointed this out. There is a bearish trend line coming down from 2008. We hit it in 2011, couldn't get above it. It looks like we're now, it's around about that kind of 39 level, between 38.50 and 39. That's a significant level anyway, because not only does it coincide with this, steep weekly trend line resistance, but it's also the high, very close to the high of the year so far, which comes in at 138.33. That was the high from the 25th of October. It also coincides round about that 61.8% retracement of the early 2011 to late 2011 to kind of the mid 2012 low or decline in euro dollar. So a really significant level. It comes in around 138 to 139. Now, what does that mean? Well, how are you meant to look at that? Well, there's a couple of things. Firstly, obviously, expect this between 137 and 138 to be very sticky, a very sticky level of resistance. Indeed, we are currently above 137, but we haven't really been able to kind of extend gains too far. That 137.50 at the moment is really, acting as pretty tough. The 138 level, we haven't been quite able to get up there as yet. That is acting as, we're currently running into just a little bit of stickiness around about that 137.60. So 138 to 139 is going to be very hard to get over on both both kind of the daily chart and the weekly chart are telling us that. The other thing that I would point out is that the momentum indicator has slightly gone flat, which suggests that the market is aware of this level, is taking note of it, and getting to 140 is going to be, it's going to take one hell of a push from the bulls. Now, obviously on that's kind of the negative side, I suppose, in the sense that expect that to be a very sticky level. The positive side of that is that obviously if we break above break above 139, essentially that would be a very, very bullish development that would lead to another leg higher. Obviously 140 is a big key psychological level, but you'd probably be looking back at these highs from October 2011, and then maybe even to the 145 level if we were to break up there. So it's all about kind of patterns and legs higher, and we're at a crossroads, but we're coming up to a crossroads in euro dollar. From a fundamental perspective, though, we are reaching this technical crossroads at the same time as we've got some quite important fundamental data coming up next week. Obviously, we have that FOMC meeting. Again, as we said, we don't believe that they will taper. Because some Fed members have expressed a few doubts about the strength of the labour market, really reflecting the overall US economy. Added to that, it's one of the final meetings of Ben Bernanke in charge at the Federal Reserve. So, is it, is it appropriate, I suppose, for him to go changing monetary policy when he leaves? At the end of January. It's his penultimate meeting, actually. He will hold the meeting in January with Janet Yellen holding her first meeting in March, which will coincide with the first press conference. However, I think, either way, I think it's a big week. Added to that, we are also moving into Christmas. So, people will be, if people have been, trading euro dollar since, the summer anyway, they've had quite a nice run up. We obviously took a bit of a dip, here from kind of October to November, but since then we have made a nice recovery. So kind of getting it back to the highs of the year would maybe make sense for some people, especially if they're kind of just waiting to close out positions, really. So there are those kind of fundamental factors to factor in, and obviously, but my why I'm mentioning this is because when you get kind of a key technical crossroads combined with maybe weak trading because it's Christmas, and also a fundamental risk like the FOMC meeting, investors may just err on the side of caution, particularly when this FOMC meeting could unleash a wave of dollar strength. Just remember that. I'm not saying it will, but there is the chance that the statement, if it sounds slightly more upbeat, if it sounds like tapering could be brought forward, maybe from March, or could be, enacted potentially, say, in January. That could be that could certainly weigh quite heavily on euro dollar. So just this is more of kind of chart porn, I suppose. Just feast your eyes on it, all the levels that you're seeing. There's a lot to digest in that, and there's a lot of good stuff in it as well. Now, just looking just from a different perspective, looking at the Ichimoku cloud. Obviously, last week we were hovering just inside the cloud, but we pushed above there. The 136.40 level is the top of that cloud, and that now is really key support on the downside. So, as you can see here, looking really, really strong. Anything above the cloud is considered positive. But as we said, massive red flag warning coming up here, which is those October highs. It's interesting because I believe from a fundamental perspective, there isn't too much supporting the euro, and we see this rally as being unsustainable. So just while you continue looking at that fantastic chart, I'm just going to make another one up for you, which again just tells a different part of this story of euro dollar. For which I believe, and I know those of you who've joined my webinars, or long-term participants of my webinars will know, I always like to look at these at a chart, at these charts. So I like to look at currencies alongside interest rates, particularly interest rate spreads. So, differentials between countries' interest rates, because I do believe that is one of the pillars of currency movement, particularly in kind of the more medium term. So what does this tell us? Well, as you can see, euro dollar moving nicely. However, that spread has been falling. So at one point they were moving together, kind of back in the middle of this year. Then they kind of, they continued to move together. They moved together really all the way up till October. Again, they're making similar highs, and they fell off. And then it comes around about the beginning of November that they really started to diverge. So what we saw here was a euro dollar trend higher after making a low, a sub kind of 134. But yet what we saw was German yields lose out to US yields. So tapering talk again was reignited around about that November time. That helped boost Treasury yields, which have then kind of weighed on this spread. So as you can see, the spread is, in negative territory, and it's just getting more negative now. It's nearly at 100 it's nearly at 100, or it has been more than 100 basis points. It's close to 110 basis points going in the dollar's favor. But this chart is definitely not euro supportive. Now what we have seen is it level off just a little bit, but we've still got 90 pips worth of this spread, which is really in the dollar's favor. So what we're saying is that one of the key pillars of what makes currencies move is not supporting the euro. And again, that to me makes this seem very vulnerable. And again, it's just a red flag as we get close to this 138 level. Obviously it's significant, as I said, from a daily perspective, but when you look back at the I'll just go back to this chart now. When you go back this many years, things are significant. It's certainly worth watching. So for me, if we are to get above that 139 level and extend our next leg higher, we're going to have to see, we're going to have to see I believe we may need to see this spread follow suit as well. I think that's going to be quite an important one. Okay, what else is going on? This isn't the only thing. I also want to look at one more long-term chart. And this is Swissy. Let me just stretch that out just a smidge. This is dollar Swissy, very plain chart. Significant, very significant, because we made fresh lows. We got below that kind of 88.90 level earlier this week, and as you can see, that's a massive level of support. It goes all the way back kind of to the beginning of 2012, and it looks like we're testing it. Now, one thing I would say with dollar Swissy is that it is looking, let me just put it on maybe a slightly shorter time frame. As you can see, we are, momentum certainly has been to the downside. We do risk, let me just pull up my RSI as well. As you can see, we are moving into oversold territory there. If I put it on the weekly as well, we're just moving towards that oversold territory. You've got oversold, we've gone below a key support level. There is a risk of a short-term recovery, just in terms of positioning sense, really. As I said, that 88.90 support, we had gone through it. It had been kind of the October low. The fact that we've gone through there is certainly significant. But as I said, when we're looking a little bit stretched to the downside, the risk of a short-term recovery does increase. So right now we're trading around about that 89 level. So where could we go from here? Well, 90 obviously is a key significant level if we were to have a pullback, and then you'd be looking at this at the 50-day moving average, which comes in around about 1963. Let me just pull over my Bloomberg chart to show you that. So as you can see here, this is the key level. This is the high. We were back at that 1965 level early last week. So it's not kind of, impossible to get back there. But I think one thing that, is really standing out right now is that the FX market isn't doing what some people expect it to do. Oh, my apologies. I just hit my microphone. Sorry about that. Sometimes what you see, or what we're sometimes programmed to believe, is that, you've got your safe havens, you've got your dollar, your Swiss, your yen, then you've got your kind of risky currencies, and then like the Aussie and the Kiwi, say, and then you've got, your euros, pounds, dollar CADs, etc. What we're seeing here is that, in the risky currency, the safe haven currencies aren't moving together. So, if the market believes that the US economy is doing well, hence why it's willing to sell the yen, then why wouldn't it be willing to sell the Swiss franc as well, another safe haven? You could just argue that actually dollar yen is much more of a yen move, and it's based on the fact that the market expects the Japanese authorities to step back in with some more stimulus going forward. So, the dollar doesn't seem to be reacting to the prospect of tapering, and maybe that's because the Fed's message has finally got through that tapering doesn't mean tightening, and that just because they taper by 10-15 billion, maybe we don't know the details, so I'm just speculating here, they're still going to be enlarging their balance sheet, and that's going to limit dollar strength. And maybe that goes to explain, in some way, euro strength. The ECB hasn't been enlarging its balance sheet. Its balance sheet has been shrinking, and that's really been one of the key supporters of the euro on a kind of overall basis over a year. Now, not for a day trader or an intraday trader, that's not helped. But certainly, if you started 2012, in fact, that's quite a good exercise. Let's just take a quick look at euro. euro dollar. Just a very, very simple line chart. So we started 2013 here. We were trading around about that 132 level, and obviously we've ended it up here. Now we have had a lot of kind of ups and downs, but if you'd kind of, put your position on January the 1st, or say December, say even like, mid-December or something, you would have, been, just based on those relative balance sheet fundamentals, then you'd have probably put the euro to go higher, and indeed the euro has moved higher. As I said, you need to be, that's not necessarily the way to trade. It's not the way for everybody to trade, but it's just an interesting exercise, just to show really how important those fundamentals are, particularly on a long-term directional basis. It's the fundamentals that really determine the direction. So, what could potentially turn around then? Well, number one, if the Fed's balance sheet starts decreasing, that's going to be a real key thing, really going to strengthen the dollar, we think, in 2014, if that starts to happen. The other thing, of course, is, if the ECB embarks on some form of QE, so if we get some very negative data, more negative data, maybe those stress tests aren't fantastic, they won't be released till late 2014, but if there was some sort of radical action, and we're not saying there are, in fact we don't believe there will be, certainly not in the first quarter, and then what we could see is that could be the trigger that really weighs on the euro. Just going back to this Swiss franc though, as I said, the Swissy hasn't been moving out of the safe havens. If you were just trading safe havens, what you can say with some certainty right now is that the Swissy is the strongest of the safe havens, the yen is the weakest, and the dollar is somewhere in between. There's no kind of rhyme or reason at the moment, and there shouldn't be. Markets are moving much more on fundamentals. That makes it much more fun to trade in the market. One thing, obviously though, we have been used to really since 2008, are these kind of correlations within the FX market actually holding up. Well, they seem to be breaking down very much at the moment. If you were, for example, trading the yen, the dollar as a carry trade, for example, you wouldn't necessarily have done very well if you had a lot of dollar yen in your basket. However, the yen on a broad-based basis, just to show you, maybe the fact that, what we're seeing in dollar yen isn't necessarily just a dollar move or just a sign of dollar strength. Let me pull up the trade weighted yen chart. And as you can see, this is another thing, right? So President Abe, this is probably around about his 1 year in office for him, or 1 year kind of since kind of Abenomics came into being, and it's had tremendous effects. This is trade weighted yen. They wanted to weaken the currency, and he's done it. This is basically trade weighted, for those of you who don't know. I'm sure all of you do, so I do apologise if I'm repeating myself, but it's the yen against its largest trading partners. So it's a broad-based view of the yen. So as you can see, the yen is weak. This is the yen, so the yen is weak here. The yen, is coming back a little bit as a carry trade. What's been kind of interesting though is what you trade it against, because let's have a look at Aussie yen. Your traditional, risk sentiment, very, very sensitive to risk sentiment. It's really traded sideways, whereas you'd have been better looking at euro yen or sterling yen, which made multi-year highs this year. This is sterling yen here, very close to that 170 level now. If we just go back 5 years, sorry, we need to go back even further, I believe. In fact, this is pretty much, such a, it's a decades, it's such a high level that we're at right now. We're at the highest level since 2008, so pre-financial crisis levels. The one thing that we point out as well is that we are getting into some key resistance zone of moving averages, which comes in around about between kind of 175 to 185. So that could potentially thwart some of the bullish sentiment. But I think at the moment, the way things are going, the yen seems to be going one way. But just remind yourself of that yen chart. That was very weak, if you remember. I'm just showing you now. So is the dollar index. So the dollar index on a broad-based basis is very weak. So, safe havens aren't really in demand. Well, certainly the dollar and the yen isn't, even though the dollar is massively outperforming the yen. I just want to show you this dollar index for a couple of reasons. Let me just annotate it quickly. Firstly, that's what I've just circled, which is the 50-day moving average. We break decisively below there, which comes in at kind of just a tad below 80.35. We're now approaching that 80 level, which is significant. Obviously, this isn't the lowest that we've been to, this year by any means. The lowest was 78.90 from February, from the start of February. So we're still way above there, but we are looking very, very weak in our most recent range. So that's why we would be concerned about that. If we just take a look here, and there's also a trend line, that's certainly capping the upside as a bearish trend line, and we are, certainly trending lower, you would argue, in dollar index at the moment. So dollar index, when that's trended lower, that's trending lower. We've already gone through how, it's not as broad based as this suggests, with the euro really, the dollar really weakening very strongly against the euro, but actually strengthening against the yen. But the pound has also been a big beneficiary, with cable rate rallying quite strongly. As you can see, we managed to push back above that 164 level. Yesterday, we were just hovering around it, but we did push above it. Mark Carney was speaking yesterday evening. He didn't really say anything we didn't know already. He tried to sound very dovish, but it just seems to be this perverse thing whereby Mark Carney tries to sound dovish and the market goes against him. Basically, he didn't really suggest that they're going to do anything to act on their dovish credentials. He reiterated the same message that, an unemployment rate doesn't necessarily, a falling unemployment rate doesn't necessarily mean they're going to hike rates. They'll do something else first. But I guess the market is just kind of challenging that, particularly if we continue to see strong data, which a lot of people are expecting, obviously, for it to come off the boil a little bit, but certainly not to go cold anytime soon. So what we're seeing here, as you can see, we're above that 164 level. 164.40 is certainly worth watching out. That has kind of stymied the bulls in the past, and we need to get above there. But where are we going kind of, post then? Let me just look at this. In fact, let me just pull up my other chart. It's slightly easier to see. And let me get rid of some of this. So this is the weekly chart. As you can see here, we're at the highest level now since 2011. And as we, continue to extend gains, we can get above that 164.5 level. It really opens the way to the to the August 2011 highs around about 166.20. That's what a lot of people are looking at. I would point out we are starting to look a little bit overbought. Let's just go back to the daily chart there. Again, just an overbought condition. So 164.5 is really acting as quite strong resistance there. So do watch out for that, because that could certainly weigh. We could just be in for kind of, like I said, with a dollar Swissy, just a bit of a short-term reversal. There isn't too much economic data out later today, so I don't think it's going to be anything major. This would be very, very normal in such a strong trend that we've seen, and after having such a strong move higher. Now the Aussie, I know some of you absolutely love the Aussie. Let's take a quick look at this. The Aussie is, it's made a nice recovery. It had gone sub 90 earlier this week, but as long as resistance of 91, around about 91.65 holds, that's the 38% retracement of the last sell-off. And then we could see kind of a further extension of the bearish pattern. And as you can see, the bearish pattern is very clear to see. It's just a series of lower highs and lower lows, and that was very prevalent in the last couple of weeks. We've since kind of just moved sideways. But for me, we think that we will test critical support at that 88.90 level. So that's the lows of the year so far, around about August and September. That's the August 30th low. So that's the level that we'll be watching there, which is the 88.90. We think that will act as very strong support, but obviously any move towards that 91.65 resistance level could be faded by the market, looking for another sub 90 move. Obviously, the Aussie is weakening on a number of fronts. It hasn't been able to muster too much strength, even though exports to China rose to a record. That's because overall Chinese imports actually have been falling. So even though Australia's been benefiting benefiting in recent months. Looking forward, doesn't look that good for Australia. Likewise, the RBA are still keeping their options open. They still don't like the strength of the Aussie, and that could just keep them erring on the side of dovishness. Now, I do just want to run through the New Zealand dollar with you really quickly as well, guys, and then I'll take a couple of questions. I know I've been hogging all of this, but as you can see, this is the New Zealand dollar. It's a daily chart, trading in a bit of a downtrend there. We have got a very important week coming up for the Aussie. We get the monetary policy statement. Oh, let me just pull this over here. Monetary policy statement from the RBNZ. Just get you the exact details on that. Bear with me. That's going to be really important. That comes out on the 11th. So what day are we? That's tomorrow at 8 o'clock. So tomorrow evening, after the London markets are all closed, we get the cash rate from the RBNZ, and then it's that monetary policy statement, which is going to be so important. No change in rates are expected, but it is worth listening out for. Now, obviously, we have seen in the past that the RBNZ have been worried about Kiwi strength. They still think it's too strong. However, they have kind of hinted that they may have to hike interest rates. If they continue with that theme, then what we may see is just getting above this key resistance level, which comes in about 82.95. If we can break above there, then we could see another further recovery back to the 85 level. Obviously, a lot of the market is now pricing in for a March hike from the RBNZ. So, the RBNZ or New Zealand expected to be the first of the G10 central banks to pull the plug and actually to pull the plug on all this liquidity and start tightening rates. Obviously, the risks are maybe going into this RBNZ meeting that they don't do that he actually maybe sounds a little bit more cautious and doesn't suggest that a rate hike is on the cards, maybe says that he's going to do more, a bit like what Mark Carney said yesterday, to try and kind of weaken the housing market. It's all because of house price appreciation that's really weighing on the Kiwi. If that happens, then we may fall back down. This is the 21-day moving average, which comes in at just below 82.40. And we think that would act as very good support, because at the end of the day, house prices are still rising very dramatically, even with some of the macro-prudential measures that the RBNZ have put in place. So we still think there is a good chance that the RBNZ will have to hike interest rates, because what they're doing at the moment is not having too much of an impact on their housing market, and that's kind of the key thing. So Mark Carney, take note of what the RBNZ ends up doing. But that's my spiel over, guys. If you've got any questions, I'm happy to take a couple. I know we've got a couple of minutes before I have to let you all go. Do let me know if you've got any if you've got any questions. I'm happy to take one or two. You're all being very quiet. Maybe I've bowled you all over. Let me just show you gold quickly. I know some of you are watching gold. There's a good few of you that love gold. I know who you are. Gold has made a nice recovery. It suggests that this 1200 level, it's really being picked up on the dips. We had got to kind of, around about that 1215 level. But 1200 now, massive level of support. It is holding up. Now we are getting very close to these highs around about 1255, which could act as, some resistance, certainly in the short term. And then the slightly longer term, as in next day or so, if we continue to trend higher, 1287, the 50-day moving average. To be honest, I think we're going to trade sideways. We're going to consolidate a little bit heading into that FOMC meeting. Obviously, if the FOMC meeting does anything like a surprise taper or suggests taper is on the cards for January, that's when we could get below 1200. And I think a lot of people are still thinking that the upside is limited. But for now, anyway, the dips are being picked up. But one thing that I would say is just a little bit maybe worrying, especially because gold has been, trending, pretty much for the last 12 months, just trending lower. The fact that, we were picked up on ahead of 1200, but we haven't really extended too much. It's been quite a boring, plodding move forward. There's not been a real push by the bulls to get us higher. So for me anyway, gold is still very much in the doldrums. Well, okay, guys, if there's no questions, thank you all so much for joining. Please do join us again. Oh, sorry, Michael, you want to look at Sterling Aussie. I'll happily look at that before we go quickly. This one, again, been a big winner. Largely because we've seen sterling rally and Aussie has been very, very weak out of the G10. So this cross has been kind of one of the beneficiaries of that. Obviously, we are getting stuck a little bit around about that 180 level. If we just go, let's look at a slightly longer chart. As you can see, it's still looking very good. This is a very long chart here. That 180 level does coincide around about, say, 180 to 1. If we get above 180, then 185, which is kind of these highs really from 2010, come into view. And that's when, I can even go back to a 5-year chart. That's where we may see, the kind of the next level of resistance. But as you can see, still looking strong. As my view, I would say, Michael, look at what Aussie dollar's doing, because this is a cross. It's going to be very impacted with what cable's doing and what Aussie dollar's doing. As I said, we may see a bit of a sharper pullback in sterling Aussie if we are to break above 91.65 in Aussie dollar, but if we don't, then that could be kind of a trigger to move higher. And likewise, we are looking for some short-term strength in sterling against the US dollar as well. So, overall, you've got a strong sterling and you've got a weak Aussie. Go figure, I suppose, put those two together, and it suggests we could move higher. This was kind of 2009, we were significantly higher from where we are now. So certainly worth looking at there. Okay, everybody, thank you for joining. You've been great as always. Thank you so much. Come and join next week. That will be the last one before Christmas. And we can, I'll chat to you all then. But great to speak to you, and thank you, everybody.